Welcome to the Ag Commodity Corner Plus. My name is Mo Agostino. This is Abhinash Gopal, and this is our first venture into a digital podcast. We were supposed to start this on March 28th, this past Friday, but we had some technical difficulties, so it's Monday, March 31st. It's about to just past 10 o'clock. So we work with farmers across North America. We can manage every risk in your farm. So it's our first venture into a weekly summary podcast where we're going to try to show you what was moving markets for the week. So hope you enjoy it. So to start off with, you can see what the markets did last week. I've highlighted in the chart for those of you listening on audio. Oats had a big move to the downside, but oats, very few players in that market, so it can be manipulated up or down in any given day or week. You can see soy oil was much higher, which helped support canola and higher soybean prices. And we'll get into some of the reasons why. Minneapolis, wheat, Kansas, and Chicago were all lower. Chicago was down 30 cents. We had the Dow down over almost 500 points. And we had gold moving higher as well as silver, and we'll get into that as well. Okay, Abhinash, let's start off with those new U.S. shipping fees at ports.
Okay, Mo, so new US shipping fees at ports. Last week there was headline news that Trump was looking to apply new shipping fees on all vessels at US ports as a way to resurrect the US shipbuilding industry. The fees could amount to as much as 1 to 1.5 million per vessel. Currently, over 90% of the global fleet would be subjected to fees.
The problem with this, it makes the U.S. less competitive if they move forward with this. The NCGA stated that it would cost corn another 30 to 60 cents more in freight. A lot of U.S. corn is shipped out of the PNW in the Gulf. It would cost soybeans another 7.5 to 28 cents. You can see from this chart that China is not a big buyer of corn, but Mexico and the EU and Japan kind of rank the top three, but China is a big buyer in soybeans. It's one of the largest, and this past week China was saying that if this trade war with the US lasts through year end, their share of Brazilian beans at 71% could jump to 80%, and that means the US's share at 20% could fall. Let's talk about those tariffs this week, Avinash, and the 25% autos and reciprocal tariffs.
So, US President Donald Trump will impose a 25% tariff on all cars that are not made in the US starting April the 3rd. But it will get stacked on top of other universal tariffs and would be made permanent for the whole of Trump's term. This could increase the price of a foreign vehicle in the US by $3,000 to $15,000. And on top of that, on April 2nd, Trump is also expected to announce reciprocal tariffs against the rest of the world.
What this chart is trying to show is that, and this is one of the reasons why Trump is trying to initiate these reciprocal tariffs. G20 nations have 4,650 import restrictions since 2008, up tenfold since 2016, while U.S. average tariffs amounted to 8.4% in that same period, matching 1946 levels. So he's trying to basically say, look, you guys are not playing fair, and he's trying to level the playing field. I mean, actually, let's talk about the ceasefire in Ukraine-Russian war.
Ceasefire and end to the Ukraine-Russian war, possibly. A ceasefire deal, which could be temporary or near-term, seems to have been verbally agreed by Russia and Ukraine, brokered by the US. But Russia is dragging their feet as they ask to have access to the SWIFT global banking system again. Russia, as we know, is the largest global wheat and fertilizer exporter and the second largest crude oil exporter.
So many think that this war, if it comes to an end in Ukraine-Russia, could be bullish wheat, but we're of the opinion that it's going to introduce more competition, more production, particularly from Ukraine. It could take some time, but if you lift sanctions on Russia, it could be bearish fertilizer, it could be bearish crude oil because of production going up, and I think it would remain bearish for wheat. Let's now talk about the 45Z and biofuel policy.
Headline news last week again on 45Z and the US biofuel policy. US President Trump has requested the biofuel and oil industries to work together and hash out a deal for the country's next phase of renewable fuels standards biofuel policy. Sources said the group has already agreed in principle to ask the EPA to significantly raise the mandate for renewable diesel and biodiesel from its current level of 3.35 billion gallons to possibly 4.75 to 5.5 billion.
So short term, you can see from this chart that companies have divested themselves out of this industry because they're really tired of waiting for this 45Z US biofuel policies. But this news last week, headline news from Trump saying to work together to come up with a policy is good news. And one of the reasons why soy oil was up and supporting higher canola and soybean futures. Let's talk about, this is just showing you the soy oil futures. You can see the last few days that we've been bouncing higher. And, if we're moving away from China buying US beans, we need a local demand source to help all those beans that they produce in the United States. Let's now talk about the Hogs and Pigs report.
We finally last week got a bullish USDA Hogs and Pigs report. Prior reports had been showing strong productivity that offset overall inventory reductions. In the current report, pigs saved per litter came in at 11.65, which was 6% higher versus 2 years ago and 1% higher than a year ago. The breeding herd was smaller, but the pig crop was higher.
USDA is still overestimating supply. If you look at U.S. slaughter to date, we're down about 4.1 to 4.2%. This was a friendly report, but you still got to get past these reciprocal tariffs on Wednesday. We're concerned that someone like Mexico, who buys 40% of U.S. pork, will start to retaliate, and that's never good when the funds are trying to reduce that risk. If you do want to try our premium program, we do have, you can sign up at riskmanagement.farms.com. It's an 8-week free trial program. We also offer an app for your smartphone where you can keep up to date with this game called marketing. So if you want to try that, visit our website. Let's now talk about the USDA reports that come out today, Abhinash.
USDA will release the March 31st prospective plannings and grain stocks reports. For the report, trade sees 2025 U.S. corn acreage at 94.36 million acres and soybeans at 83.76, but the range of trade estimates for corn and soybeans is wider than normal. March 1, U.S. corn stocks are expected to be lower year on year, but soybeans and wheat are expected to be higher. More.
USDA's the analyst estimates for corn at 94.36 I think are coming in too low. The whisper number is 96. If you get a 96 today, that would be very bearish. Bean acres have to come in below 83 million. This is not a wheat report, but I would expect spring wheat acres to come in lower, as well as cotton. We've switched a lot of cotton and maybe spring wheat to corn. In the quarterly grain stocks report for March 1, that 8151, that's all about feed, ethanol demand. Ethanol demand been strong, but ethanol stocks have been record strong, so that's a problem, and production can come down. And then we don't get a weekly feed number, so if we're feeding less animals, a lower feed number could offset a higher export number, and so that number may not surprise, but it'll be interesting to see how it comes out today. Let's talk about the weather.
U.S. weather is not as dry as it was in January. U.S. precip ranks for the month of March so far show much improved conditions across the core of the Ag Belt since Jan. Many areas still struggle across the plains, with some areas in the top 10 driest.
In this chart, you can see, if you look at Iowa, that top corner, northwest corner, it shows that it's the driest in 131 years versus 133. This was January, but you roll forward to almost the end of March, and all of a sudden that top corner is only ranked 36. So we've got a lot of moisture, and in the next 7 to 14 days, it looks very wet. Hard red winter wheat country is supposed to get about 148% of normal precip. Both corn and soybeans between 140 and 160% of normal precip. So it does not look like an early planting season. There's going to be a window probably at the end of April, but it looks like May may turn wet again. Let's talk corn exports.
Is the U.S. corn export pace slowing? USDA weekly U.S. corn export sales in the latest report, which was for March 14th to the 20th, was at 1.04 million metric tons, and the pace has slowed down to 24% higher versus last year.
You can see from this chart that both Mexico and Japan represent 52% of the total corn exports. So far, we haven't seen any cancellations, but I'm very worried that on Wednesday, Mexico starts to retaliate. We'll see, because I think you're going to start to get tariffs stacked on other tariffs, and we're hearing that Trump and his team want to increase. We want a broader tariff rate that's higher come Wednesday, and so this 24% is great. USDA is at 8%, but does that pace continue to slow moving forward? Let's talk about U.S. inflation.
US PCE inflation numbers were released last week. The US core PCE, which stands for the Personal Consumption Expenditures Price Index, which is US Fed's preferred inflation measure, showed a 0.4% increase in Feb, putting the 12-month inflation rate at 2.8. Both are higher than expected.
One data point doesn't really change much, but this is going in the wrong direction. The markets are not gonna, stock markets are not gonna like this. We'll have to wait and see. Is it due to tariffs? Fed Powell thinks it might be the start of it. Again, Trump's tariffs are on steroids versus 1.0, so it could start to have a problem with stagflation, where economies start to slow down and inflation starts to go higher. Let's talk CFTC report, Avinash.
The funds continued to sell ag commodities for the week ending March 25th. So as you can see on the screen, corn net managed money positions came in at 74,607, which is a reduction of 32,663 versus the prior week.
The funds have basically gone short. The ag commodities are still long livestock. I would not be surprised. Be careful here. Today's report, 96 million with reciprocal tariffs on Wednesday. I would not be surprised if the funds are short corn by the end of the week. We could see corn fall below $4. That is a risk going into this week. And finally, let's talk about some of the chart damages on corn and then wheat.
So in terms of corn, we took the stairs up, but the elevator down. The USDA January crop report was bullish, and that was a gift for futures. And in terms of wheat, the bear market in wheat continues, and wheat global demand weighs on.
So you can see on the chart there, the support's 443 and a quarter, the ceiling's 490 and 3/4. You're starting, new crop starting to break that. We haven't broke that level on May, but if you do, you're heading right back to the lows. And then when it comes to wheat, you remain in that 3-year bear market. You go back to 2018 and the lows were in the fours. So that's your risk, unfortunately. We hope you enjoyed this podcast. We'll see you next time. Next podcast is this Friday, April 4th. Take care.